Good morning, everyone. Thank you for tuning in to today's Daily Bread. It is December 3rd, and we here at Harvested Financial are looking at the markets today. So what's going on overall in the marketplace? We have the SPY sitting almost exactly where it closed yesterday. I see SPY at 366.80 right now, barely a tick red or green in any direction. Qs are up just a hair, and IWM is also up just a hair, just a couple basis points here. So another calm day out here. But I want to circle back to one of the names that we've been looking at in the past. And we talked about them earlier this week, but Palantir has had quite an active week overall. So if you'll remember, this is the data science company that has a ton of government contracts. And I think that's one of the big bull cases here. However, yesterday, Morgan Stanley came out and downgraded them. So Morgan Stanley downgraded the stock, and that caused a huge sell-off. We saw a pretty big spike in volatility, but that's actually come in a little bit since that actual downgrade. So, Morgan Stanley downgraded them. I think some of the skepticism, despite all these really lucrative government contracts, is the fact that the stock is already trading at such an insane multiple compared to some of its other software as a service type peers. So it's trading at a forward sales multiple of something like 33, 34. Its peers are usually only in the 17-ish range. Now, those contracts help, and the guaranteedness of them is certainly lucrative. But what are we actually seeing in this name going forward? So many analysts are coming out and saying that, this downgrade and this sell-off is an opportunity for bulls to kind of lean into the name. But despite that skepticism, we do still see something like 5% of the float as being sold short. So I think given the short interest, given the activity of traders in this name, we are going to see continued chop here. So one of the things that I mentioned was that implied volatility has actually come off a little bit. And I'm going to share my screen briefly here so I can show you exactly what I'm talking about. So when looking at the historical volatility here in Palantir, is that I'm going to highlight this real quickly. So in red is where we see the historical volatility, and that's going to be the close to close historical volatility. So measuring close price to close price. And if you'll follow this red line up this way, that historical vol continues to go up. Obviously this little spike right here came with that downward movement in the stock price. So we did see a little bit of a surge in historical volatility, but interestingly enough, I'm focused on this declining implied volatility. So I'll pop it in and out so you know exactly what I'm talking about. Again, the red line is the historical close to close volatility, and the yellow line is the stock price. So we saw highs up here in the 29 range earlier this week, but we've fallen all the way back down to 22 here today. So that's corresponding with that spike in historical volatility that I'm looking at. But now I'll pull it back up is the implied volatility and what that's really doing here. So if you take a look at the 30-day implied vol, it's come in quite a bit. We're really seeing that fall. This is that white line right here that I'm looking at, really come off. The 60-day is telling a very similar story. So ironically, the implied volatility is actually coming in a little bit here. So one thing that might make you think is that, hey, maybe is this not only a buying opportunity for the equity and leaning in a bullish direction, but maybe this is also a way to do that through getting long options. Now, these options are expensive, no doubt. So despite this drop in implied volatility, coming from, over 160 at the end of last week to, down closer to the 140 range now, that is coming down, but these options are going to be expensive. So let's take a look at how expensive these options are that I'm talking about. So I'm going to look at Jan right here. And in Jan, the markets that I'm paying attention to, just off the bat to kind of get an idea of price and how expensive these options are and what that, 135 volatility, 140-ish range volatility really means. So a stock trading at 24 right now, I'm going to look at the at the money straddle. So the at the money straddle is this 24 straddle, and we have it worth, 450 and 435-ish. These are reasonably wide markets, but they've actually come in quite a bit already this morning. So 450 plus 430, gives us almost a $9 straddle. which is expensive. A $9 straddle on a $24 stock is over 35% of the stock price. So the straddle is fat. If you buy a $9 straddle on a $24 stock, your break evens are going to be far away. Your break evens are going to be $9 plus that $24 on the upside for $33, and you're going to subtract $9 from 24 to get a break even of 15 on the downside. So if you buy that straddle, you need to see the Palantir close below 15 or above 33 to make money. Wow. Implied vol is really expensive here. People are really suspecting this move. So I'm going to show a way that I think we can stay exposed to long volatility while also having a little bit more of a bullish bend. I think, there really is a lot of optimism here. And I think if we take some of this drawdown from the last couple of days, that might actually present another a buying opportunity from an equity perspective. So I've got a trade queued up here that's a little bit of a flavor of that broken wing butterfly, the Modifly that we really like here at Harvested Financial. This strategy actually forms very much the core structure of our model portfolios here. So this broken wing butterfly is a great way to manage a volatility risk in addition to giving yourself some directional bends. So instead of spending $9 for that straddle, we're going to find a trade that is relatively low risk. Defined risk is always important and can be achieved for a relatively low entry price. So what I'm going to do is I'm going to start by buying 2 of these 24 calls. So I'm going to buy those 24 calls. This is going to be the kind of center point of my trade, and I'm buying them, so I'm getting long volatility. To cap my risk and really to manage my expenses, because the price you pay on the entry of a trade is very much a risk factor. So to cap that risk and reduce my cost and reduce my risk profile, I'm going to sell these 22s. So I'm going to sell the 22 calls, buy 2 of the 24 calls, and then I'm going to sell the 27 calls also. So 1, 2, 1. And what that does for me is that gets me long volatility with a bullish directional bend. I'm still looking for movement here. We still are expecting the stock to move before our January 15th expiration. If history's proven any guide, this certainly does move. So here I'm going to show you what this would look like in a what if scenario. And so the what if scenario is a really good way to analyze what your expected P&L in a trade is going to look like. So we compare our expected P&L points to where the stock is going to close on expiration. So looking at my what if chart right here, I'm going to focus on a couple different points. The first point is that $24 strike. That's right where we are right now. If you'll recall, we bought 2 of those 24 calls. So buying 2 of those 24 calls is similar to a straddle trade that we're looking for this stock to move. So that's going to be our max loss point right here. And one contract would lose $170 at expiration if you put on this trade, and Palantir cratered right exactly to 24. If you'll recall some of our other videos, we talk a lot about how theta decays exponentially into the end. So it's not going to hit that max loss point until the actual very close of the trade. To give you an idea of how close that is, on January 16th, if stock is at $24, you'd lose $170. Just 4 days earlier, if stock is at $24, let's get that number, you would only be losing $25. So the decay here is really exponential and falls off a cliff at the end of the expiration of that option. So getting back to what our expiration P&L looks like, worst case scenario, stock just sits right here. That's what happens with a long volatility trade. However, we do have 2 nice profit zones here. So the first profit zone that I'm looking at is this upside. And that upside gives us a nice $116 of profit anytime Palantir closes above that 27 strike. So that 27 strike, if you'll recall, was where we got short the call. So we sold the 27 call and capped our risk really. And we capped our risk by receiving money and entering the trade at a lower price. So we've capped our risk to the upside, and any closing price above $27 will make that $116. On the downside, you also recall that we sold the 22 call. So below $22 in Palantir, we will make just under $20, about $15. So if we do see a downward shift in this, Volatility cuts both directions. A downward shift will only make us $15 because we've skewed our bias towards the upside. So on the upside, we make our $115. On the downside, we make our $15. And if it sits right here at the very last day, we lose $170. So breaking the wings here really gives us a way to adjust our bias, remain long volatility at a managed cost. So it's really important to enter the trade at a price that's going to be favorable and manage your risk profile going forward. Paying 27 cents on this trade to enter in, relatively cheap profile. So for $27, you get this kind of risk reward profile where we see movement in Palantir, it'll pay off to the upside or downside with a distinctly, better outcome on the upside. So a thing to think about as you manage this trade over time is where we are going to land. I think you'll see some of these interesting time profiles that if we see a big rally early on in the trade, maybe that's an opportunity to take profits. If we see Palantir settling down here with only a day or so to go, and it seems like volatility continues to crater in, well, that might be an opportunity to close out early and sort of scratch on the trade so we can move forward. Being long volatility here really means you won't see that worst case scenario until the very end when your options premium will just absolutely deflate. High volatility options are going to move around a lot. So the price of these options could change significantly over the lifetime, depending on the volatility environment. If we see the volatility environment come in quite a bit, 140 is an elevated level. If we see that volatility come in, this profile will also tend to lose because the market is pricing in less of a chance of a move. And those long options that you're long are going to decay. They'll not only decay, but they'll lose premium due to the volatility compression and the vega risk that you have on there. So some really interesting options in Palantir to look at today. High volatility name, very active, a lot of speculators involved in here and a lot of discussion about the name. There's really deep and rich liquidity in a name like this. However, the markets still remain a little bit wide, so execution, as always, will matter. Good luck out there with Palantir. At Harvested Financial, we manage these strategies for you. So we have exposure across broad benchmarks like our IWM, QQQ, and SPY model portfolios, but we also start taking a look at names like this and can custom tailor option strategies for exactly the profile you'll look at. Tune in here every day, 8:35 Central, 9:35 Eastern. We'll be talking about the markets, and you can always find all kinds of other good content on our YouTube channel right here, but also on Twitter, where we are posting constantly under harvested_DAFE, DAFE, because derivatives are for everyone. Thank you so much for joining us. We appreciate you all, and tune in tomorrow.